Welcome to Retire Mentorship. I'm your host, Freeman Lindy, certified financial planner and enrolled agent. Today we're going to do something a little bit different. I am going to go through some of our investment strategy. This is mostly for my clients making a summer update to some things. And so I am going to just explain some of the background to my clients and why we're making these changes, why we're not making some changes, why we are making some other ones. And we want to give them the full. So you, as a general audience member, if you follow the podcast, my YouTube channel, you're going to get a little bit behind the scenes on how we do investments. So making part of this kind of part one public to anyone, because it's a lot of the same things that we teach all the way through. Good refresher for you as a guest and to my clients. And also then if you're interested or you like the way we actually invest and you want to check out more, you do have to be a client to see part two. So you also may know this format's a little bit different. You got a whiteboard up here. We're going to try this and let me know in the comments if you like this method. If you're listening to this on the audio on podcast, switch over to the video feed. You are going to want to see this. This is going to be heavily visual and not, you could listen to at least the first part. You could use the audio, but you're not going to want to do the audio for too long there. So investing strategy. What are we doing here? A couple things. There have been three, really two so far, and now a third shift away from public investing strategies, right? So what you would hear in a blog, on a podcast, even on my podcast, right? We have to be careful what we say publicly, right? Because anyone can listen, anyone can see, take it as investment advice. And so generally public investing information needs to be somewhat dumbed down. And so we are making some shifts away from what you would hear commonly we have in the past. The first big shift that we made was an equity focus, right? Everything I do is all about owning equities, about owning stocks, right? And that is a big focus of our investment strategy. And right, so you've heard me say this before, right? We want to be business owners of the best businesses in the world. We don't buy stocks, we don't trade, we're not just investing, we are business owners in the best businesses in the world. When they do well, we do well. When they go through a rough time, we as business owners go through that same rough time, right? I'd rather be an owner, not a loaner. We can either lend money to businesses and governments in the form of bonds and CDs and other things, or we can own them. Would you rather be an owner of Google, or would you rather have lent money to them? Would you rather own part of Apple and have owned it for the last 3 decades, or would you rather have loaned them money at 4% 3 decades ago, right? Spoils go to the owners. We want to own things, not loan to them. And then when it comes to retirement, right? This is where a lot of people would agree with that, right? Own equities, own stocks when you're young, and then when you get to retirement, shift away, preserve that wealth, put it into fixed income, into bonds, all those things, and you should have a different percentage of your retirement savings in fixed income. And for us, that's where we depart from a lot of conventional wisdom. I don't want to call it wisdom, the conventional strategy, where a lot of people say, oh, hey, based on your age, you should have X amount in fixed income in retirement, right? A percentage of your money should be in bonds in fixed income. And we say, no, you need years of withdrawals set aside in fixed income, not percentages. You don't live on percentages in the real life, so why would you do it for retirement, right? You want years of withdrawals. If you're not familiar with that at all, if you can read my book, you can become a client. If you're a client, you should kind of remember us talking about that. And then it's stay the course, stay invested. This time is not different. It always feels different. The instigator of the modern crisis is always something new. Thankfully, we don't make a lot of the same mistakes over and over again. There's that saying, right, that the same lesson will be taught until it's learned. And we do tend to learn as a country, and we don't make the same mistakes again. So it's always a new crisis, but the result is always the same. All right, that we pull through, we stay the course, and we don't freak out, we don't sell out, we don't move things back and forth in a crisis. We just ride it out, right? We might take advantage of some downturns and make some positive moves, right? But we're never selling low. We're never trying to get out of the market before it crashes. We're not trying to time it. We're not trying to do any of those things, right? There's 4 horsemen, all of that. If you've been following for a long time, you'll know what I'm talking about. If you're a client of ours, you'll remember some of those things. But we stay the course, right? So equity focus, we're much more focused on owning equities than the average or public advisor is. Number 2, one of the other big shifts that we made away from public investing strategies is that we avoid international. I don't know if I've said that yet on the podcast, on the YouTube channel, but my clients are not invested in international. Here's why, right? The main reason people would is they want that diversification, right? They want, well, hey, if the US market goes down, we want to be invested elsewhere. We don't want all of our eggs in one basket. Let's put some in other countries, right? Don't have a home bias, blah, blah, blah. But mostly, right, if the US goes down, then we want to be safe. We want to have things diversified outside of the US. But in reality, there's no safety during global crises in global investments, right? And we're going to get deep in the weeds here, especially in part 2. But here's just one other important thing, right? Let me look at, if you are a client of ours, you'll be familiar with some of these charts. But again, I don't know if I've shown these in the podcast yet. This is a asset class, you may have seen some of these, right? Asset class return tables for 2000 through 2024, right? And all the different types of investments you could be in, they're all over the place, how they rank against each other, right? And the percentages that they did inside that calendar year. In reality, there's quite a bit of difference between how things perform overall, right? And you can see that in general, I don't know if I can even zoom out on this, they are all over the place. But most importantly, when we look at, as far as international investing goes, when we look at things like 2008, right? So here's 0, right? Most of the time investments are positive, right? They're above that 0 line, all the way up into the plus 30s and 40s, way over here, right? Some really good years there. But sometimes we have bad years, right? So again, we look at all the way back to 2000, 2001, etc., that thing. When we look at the different, where things are ranked, right? Here's the US stocks, US, up here's international, here's emerging markets, so it's like new company, new countries, emerging markets. So everything was down, and international was down just as much as US companies were back in 2001. In 2011, all right, we'll erase these guys here. In 2011, we've got, U.S. equities kind of low, some were pretty low things, some were down. International, right? Okay, so it didn't help us in 2011. We look at 2008, 2009, skip that one, right? Because it's way down here. Go way down, U.S., right? U.S., international. Right? So in the biggest market drops that we've had, 2001, 2008, didn't help us at all. Let's look a little bit more recently, all the way out to 2018. Again, US, internationals. Worst performers in 2018. In 2022, during the Russia inflation scare, all those things. Again, you've got US, international. When the US market goes down, so does everybody else. It just happens. There's no safety in diversifying globally when it comes to international investing. And so that's where, right, we just, when we look at that reason, it just doesn't hold water. So that we don't do it there. The other thing is we would rather own the profits than the transactions. Right? And so when we own giant companies like Apple, like Amazon, these types of things, right? They do a lot of business overseas, right? They're doing transactions in those countries, but we don't want to be where the transactions are being done. We want to be where the profits are. Those companies are owned here in the U.S., and so that's where we want to be. So we have international exposure by owning multinational companies based in the U.S., and so we still have some of that global diversification, but we want to own where those profits are coming back to. And so we'll get into a little bit when we dive more into the numbers of why then we don't, right? So there's no safety in it, and we'd rather be where the profits are. And we'll see why long term that's been much better. So both of these, equities and avoiding international, have been awesome for us. And we've way outperformed your average portfolio in the last decade or so that I've been doing this, just in those two. Then one other kind of foundational element for us, right, is diversifying. That we do want to diversify, right? And part of diversification means always having to say you're sorry. And what that means, right, is that when we look at things like 2024, where like large cap growth was the top performer, and therefore S&P 500, which is mostly large cap growth, there's some value in there as well, was also a very strong performer. That because we weren't 100% in large cap growth, right? We weren't 100% in the S&P 500, which was, you could rank number 1 and number 2 as far as performance goes in 2024. Since we're not 100% those, our performance was less than those two funds, right? So we had to almost say, sorry, we didn't have the best performance of these other funds for 2024. That's okay. Because when they do really bad, we also do better than that, as we'll see from some of the data. So that's one of the things with diversification, is it means always having to say, I'm sorry. But then one of the other fundamental parts of diversification, right, is never owning enough of anything to make a killing on it, and also never owning enough of anything to be killed by it. Right? So we're never going to own that hot stock that goes crazy, right? At least not by itself, might be in one of our funds, right? We're never going to, there's a lot of these things that we're just not going to do because we don't want to be killed. We want the guaranteed, right, as much as we can, something that's always worked historically, and we want that to continue. We're not trying to chase these things that, yes, you might make a killing on it, but you might absolutely be killed by it. And so those are just a few of our things that, as we've developed our investing strategy, some of the main things that we hold to. Okay. Let's look at some of the data behind some of these things. So we've got U.S. stock market. We have that in red, not because it's bad, right? Because I use this red bucket, blue bucket analogy in my book and some of our teachings. So red is equities, blue is fixed income. So if we look at equities versus fixed income over the last 50 years or so. So we have from 2024 all the way back up to 1972, as far back as we have really, really good data on some of these things. Some of these don't even go back that far. But when you look at all these, right, each one of these years, it has for 2024, right, the annual return of the U.S. stock market versus long-term corporate bonds, 10-year treasuries from the government, short-term bonds, cash, like money market, things like that, right? And then the coloring on here is just how they ranked that year. So you're always going to have one green one in the row and one red one, which is the best and worst ranked returns for that year, and then yellows and oranges depending on where they matched up between those two for the year, right? And so as you can see, right, as we look at just annual returns, right, most of the time this equity, the U.S. market, had much better returns just comparatively into that year. What this doesn't do a good job, right, of showing is how different those returns were. You have to go back to one of those other charts to see that. And that's where we look at then at, you can look at 10, 20, and 30-year rolling returns to see, hey, how have these performed, right? And on average, over the last 10 years, U.S. stock market 12%, over the last 20, 10, over the last 30, again, 10 and some change. Whereas long-term corporate bonds, 4, 6, 10-year treasuries 3, 4, 2, 3 for short-term bonds, etc. Down in the ones and twos for cash. And so obviously long-term, right? As we know, equities do much better than fixed income does. That's why we want to have an equity focus and have more of our money there to drive that growth, and then have our fixed income just as a hedge against when, not if, the market goes down, right? Because a few times, right, get rid of these, every once in a while, the U.S. market doesn't do too well, right? Didn't do that great in 2018, was down in 2022, right? And so for these ones, that's where you want, right, something else, cash, something short-term, whatever else to protect against, This was down here, it wasn't down here. If we look at 2008, right, way down here, and you've got some other options to pull from, to use as income while that market is down. And so that's why we own it, but that's why we wanted to own mostly U.S. stocks, because those are the ones that's going to drive most of our growth. And why, right, if you're retired, this is a question I always ask clients, right? If you're going to be retired for 20, 30 years, why would you need 40, 50% of your money making, 4, 6, 3, 2% annualized when it could be making 10 and change? Right? Like that's it. The difference between those two things over 20, 30 years is massive, and we don't need 40% of your money making these amounts because you're not going to pull out 40% of your money in the next 5 years. okay? So again, if you're clients, you know much more about this. We cover this a lot more with real clients than I do on public podcasts, exactly how that works. But there you go. And then if we look at, 10-year rolling returns, right? So this is the last 10 years. That's these 10 years here, all averaged here. And this one is these 10 years, right? And just rolls all the way back up, right? How do these things do over time? And pretty well, right? So you can see that for the last 13 years of we've had good rolling returns that have done terrific. So if you're doing this 7, 7, 7, 8, 13, 13, 13, 16, 11, all these things over time, you're doing really, really well. And now, sometimes, right, you have a bad chunk. Here's 2008, right? 2008, 2009. For that chunk of time, you actually had a 10-year period where the U.S. stock market was down, right? And that's what they call the lost decade. Now, part of that, and people always freak out about this, and this is, insurance agents love this lost decade thing because it helps them sell a lot of annuities and stuff like that. Like, oh, you be careful with the stock market. Like, yes, it's very choppy, and you could have things like 2008, like the lost decade, where for a year your money didn't grow at all. Part of that, though, right, is because you had right before that some really good years, but you're measuring back from the 90s where you had some really, really solid growth years in a row, right? So it peaked, 1998, 1999. That was the bubble, the tech bubble, right? Then it drops, it recovers, and then it drops again. And so you're measuring from the top of a bubble, right, to the bottom of 2008. And so yes, you're going to have a lost decade in there. You extend that out a couple of years, you're just fine. So don't let that scare you as much as insurance agents would love that to scare you. They can sell a lot more products doing it that way. So yes, overall, right, you got these nice, really long good years of the U.S. stock market just trouncing all fixed income, right? So that's going to be much better. So that's why we put more into equities than we do into fixed income to grow that money. Next big thing that we changed, international, right? We took out international, emerging markets. We just don't invest in those. And here's why, right? Again, same thing back 2004 or 2024 year end. So we don't have 2025's numbers in here yet, right? Most of the time, as you just look at this, U.S. large cap, U.S. mid cap, U.S. small cap, like right, large, medium, and small companies, versus developed markets, Europe, etc., emerging markets, China, India, parts of Africa, etc. How do they do, right? Most of the time, if you just look at this, the green is in these ones. The U.S. market just does better over time. And especially when you look at, again, rolling 10-year periods. So 10-year returns, 20-year returns, 30-year returns. U.S. companies beat it here. If you go farther right, if you do 30-year returns ending in 19 or 14, then it was mid-cap. But either way, these ones, 4, 5, 5, 5, are nowhere near, literally half the returns in U.S. and international companies as we've gotten in U.S. companies, right? So that's why we just don't invest in them. They don't help us in diversification. They don't lower the chances of us having a bear market or down market. When the U.S. market goes down, so does everybody else. And so it doesn't help us with that. And so why would we take these substandard returns for decades when it's just not going to generate the growth that we need? You have all the volatility, half the growth over long periods of time. Now, I know someone's already thinking this. Well, in 2020, 25, in 25, international is beating the U.S., right? Boy, I'm sure glad I've owned international over the last decade. So finally at the end here, have a couple of quarters where international is doing better than U.S. No, right? We don't know how this is going to end up. But I'm not saying they never are the best, right? Every once in a while, you do get some years where international are pretty good. All right, here's one where it was the best, aka lost the least in 2022, right? You were only down 15 instead of 18, etc. Here's one back in 2017, emerging markets was the best, 2012, right? Every once in a while, you can see some green on here, right? There's a really good run on emerging markets back in the early 2000s, right? That's when people kind of, discovered them. And then they've just kind of floundered ever since, right? This is when it really got added to mainstream portfolios, was in this section right here. And then it just hasn't done very well for them since. And so, yeah, I'm not saying that every once in a while it won't be the best, right? This was really good in the opening salvo here, right? They didn't even have data on here. Then people discovered, oh, yeah, you can invest internationally. Hey, great. So they did that. It went really good because you had all this money flowing into it. Same with international, or with emerging markets, just hasn't done well since then. So yeah, so if 2025, right? If we throw a little 2025 on here, and we got all these different numbers, and these are the best ones for this year, and then they go on to do half of what U.S. does over the next 9 years, is that a win for owning international companies? No, it's not. So that's why no. Bunch of professionals, bunch of advisors are going to disagree with me on this. That's fine. That's just how we do it, right? So, and if you're a client of mine, you're a client of mine. So that's the only, that's what should matter to you. Compounded annualized 10-year returns, right? Again, U.S. has done really well. International has sucked a lot, right? And again, emerging markets had one good section here because they had all these good years up here that was averaging. The rest of it, terrible. International developed markets been pretty much the worst the entire time. So I just what evidence do we have that that's going to turn around and somehow become a top performer? Now you can be afraid of Trump, you can be afraid of the Democrats when they get back in control, you can let your political fears run your investment policy. That's on you. It's never worked out well for anyone in the past. Real quick, just back to equities versus fixed income. Again, this is always just super funny. Again, not only do you have, right, double the long-term results if you could anywhere else with any fixed income, right? But one of the other beauties is in 2022, right? Yes, the U.S. market was down about 20% at the end of the year. I think it bottomed out at 25 in October, got back out to about 20% down. Here's your long-term corporate bonds, down 25%. 10-year treasuries, down 15. Short-term bonds, down 5. Don't let the green fool you. It's still negative. It's just the least negative. And cash was the only thing that was positive that year, right? And so if you were like most people that had, 20 to 30% of your money in long-term stuff and another 10 to 20% in 10-year treasuries and short-term, right? Most people with 40, 50% of their overall portfolio in fixed income lost a bunch. And, yes, you're on 25% here. It's up 8. It's up 2. It hasn't come back yet. Where this was down 20 and then it was up 25 and then up 23. Fixed income, having 40% of your money in there just doesn't help anyone, right? Did we have some in long-term bonds? Yeah, everybody did, right? But the amount that my clients had in there was far less than anyone else, right? And so that's where, just in general, our philosophy that we teach on Retire Mentorship, right, helping you retire successfully and stay successfully retired, is to believe, stay invested in here, to have only the minimum amount we need in fixed income over here. And if we can get people to do that in general, on average, you're going to have much better results than any of your peers, any of your friends. And every once in a while, we really help by doing things like this, or like in 2025, we threw a bunch of our clients extra fixed income in equities when they were down as buying opportunities. Every once in a while, we do something extra to make extra money, which is great. And we're going to make a slight pivot, kind of go remind you guys why we invest in what we invest for in equities, and maybe some slight pivots on that, answer some questions around why do we own certain things that maybe we shouldn't, etc. But that's all privileged for actual clients. So clients, you will get in the email I send this to you a second link to part 2. And if you are just, not just, but one of our valued audience members, Retire members, thanks for watching. And if you want the rest of it, you'll have to schedule a discovery meeting, and maybe we can share it with you then. I can share it with one-on-one settings. I cannot share it publicly. So thanks for watching. We'll see you Retire members next month, and stay the course.